Hello, everyone, and welcome back to the Deep Dive. It is Thursday, January 29th, 2026. Today, we are clearing off the desk to focus on one single massive entity. We have the fourth quarter and full year 2025 reports for Mastercard.
And when you say massive, that is not an exaggeration. I mean, we're looking at a company that moved $2.8 trillion in volume
Yeah.
in just the last 3 months of the year. It's just a staggering figure.
It really is. And, our mission for this deep dive is to really look past the plastic card. We all have one, maybe two or three in our wallet. But looking at these documents, I get the sense Mastercard is trying very, very hard to tell us they aren't just a credit card company anymore.
That's the core tension in this report.
Yeah.
Absolutely. You've got the traditional business swiping the card, the rails of the economy, and then you have this explosion of technology and services. Cybersecurity, they're basically morphing into a tech giant right under our noses.
So we're going to decode what an $8.8 billion revenue quarter tells us about the global consumer, the state of travel, and this big pivot to tech. But I guess we have to start with the headline numbers that came out this morning.
Let's get into it.
Okay, top line. Net revenue for Q4 was $8.8 billion. The report says that's up 18%. But, and I was looking through the footnotes here, there's this distinction between reported and currency-neutral growth. The currency-neutral number is 15%. I feel like we see this a lot, but why is there such a gap?
Yeah, it's a fair question, and it's super important for a global company like this. You have to remember, it's early 2026. The currency markets have been, active. Mastercard operates in over 200 countries. So when they make money in euros or reals or yen, that eventually has to be converted back into U.S. dollars for the books.
Right, so if the dollar gets stronger or weaker, it just changes the math.
Exactly. A strong dollar means that foreign money buys fewer dollars, so the reported number looks lower. The 15% currency-neutral figure is it's the truth serum. It strips out all that foreign exchange noise. It tells us that the actual business, the organic demand for their services, grew by 15%.
Which, for a company of this size, MasterCard is not a startup. That's still really aggressive double-digit growth.
It's very healthy. Most companies this mature would be thrilled with 3 or 4%. But what's even more impressive to me in this report, did you see the operating margin?
I did. I had to double-check it. Adjusted operating margin was 57.7%. Does that mean for every single dollar of revenue they bring in, they keep almost 58 cents as operating profit?
It's unheard of in most industries.
Yes.
I mean, compare that to a retailer where margins are razor thin, right? Single digits. This is the beauty of the network effect.
So how do they do that? How do they maintain that kind of margin?
Think of it like a toll road. The really heavy lifting was building the road, laying the fiber, building the data centers, establishing the trust. That cost billions. But once that road is built, the cost to let one more car drive on it or one more transaction go through is almost zero.
But they still collect a toll on every single one.
Exactly. And because the network is digital, they don't have to fix potholes. It's pure operating leverage. So as revenue climbs, the costs barely move. The margin just gets wider.
Speaking of traffic on that road, the CEO, Michael Miebach, he used a specific word to describe the world right now. He called the macroeconomic environment supportive.
Supportive is very carefully chosen corporate language. It's the polite way of saying we're not seeing a recession in our data.
Right, because you see headlines all the time, doom and gloom, inflation, interest rates. But he's looking at the actual raw data. He says healthy consumer and business spending. Is that just, optimism for shareholders, or is the data really there?
You can spin a narrative, but you can't really spin transaction volume. I mean, if people were genuinely terrified about their financial future, they'd stop spending. They would stop traveling. The data here says the complete opposite. The global consumer is surprisingly resilient.
Well, let's talk about what they're swiping for, because this is where that whole identity evolution thing comes into play. Revenue is basically broken into two buckets, right?
Correct. You have the payment network, which is that classic fee when a transaction happens. And then you have value-added services and solutions.
And this was the biggest aha moment for me in the report. The payment network grew 12%. Solid, steady, but value-added services up 26%.
Yeah, growing more than twice as fast as the core business.
So, okay, 26% is huge, but what is it? What are they selling that isn't just, moving money from A to B?
This is the whole Trojan horse strategy. The card gets them in the door with a merchant or a bank. But once they're inside, they turn around and say, hey, we see all this data. Do you want our help to stop fraud? Do you want our AI to authenticate users? Do you want consulting services?
So it's cybersecurity.
A huge chunk of it is yes. Cyber and intelligence solutions. I mean, think about the world in 2026. Fraud is getting smarter.
Yeah.
AI fraud is a real thing. Mastercard is positioning itself as the shield. They were selling peace of mind. And if you're a bank, that is not an optional expense. You have to pay for security.
That makes sense why it's so sticky. Like if I'm a bank, I'm not going to turn off my fraud detection to save a few bucks.
Never. Exactly. It makes the revenue incredibly durable. And it changes how investors value the company. A bank gets a low valuation. A tech and data security firm, that gets a high valuation.
Let's look at the sheer volume, though. We mentioned the 2.8 trillion in gross dollar volume. That's up 7% globally.
And look at switch transactions. That's just the raw count of how many times a card was used. That was up 10%.
Okay, so the number of transactions is growing faster than the dollar amount. Does that just mean people are making more small purchases, like tapping to buy a coffee instead of a TV?
It signals that the cash displacement trend is still very much alive. We're using cards for smaller and smaller things. 10 years ago, you'd use cash for a pack of gum. Today, you tap your phone. That drives up the transaction count, even if the average ticket size is flat.
Now, we have to talk about travel, because if there's one metric that just screamed, the pandemic is over, it was the cross-border volume.
This is my favorite indicator for what people are calling the experience economy. Cross-border volume grew 14% in local currency.
Okay, put that in context for us. How does that compare to me just, going to the grocery store down the street?
Well, domestic switch volume in the U.S., for example, only grew about 5%. So international spending people traveling abroad is growing at nearly 3 times the rate of domestic spending.
That is a massive disconnect. Why?
It tells you everything about consumer priorities right now. Inflation has made goods, stuff expensive. People might be putting off buying a new sofa. But they are refusing to cut back on that trip to Japan or that vacation in Europe. Travel has moved from a luxury item to a necessity for a whole lot of people.
It's the YOLO economy becoming permanent.
In a way, yes. And for Mastercard, cross-border is the holy grail. The fees on international transactions are generally much higher, so a 14% jump there goes straight to the bottom line.
But it's not growing everywhere at the same rate. I was looking at the regional breakdown, and it felt like a tale of two different worlds. The U.S. and then everybody else.
It really highlights the benefit of being a global company. If you only looked at the U.S. numbers, the story is a little boring.
Boring is a kind way to put it. U.S. gross dollar volume grew 4.1%. That's
Yeah,
it's barely keeping up with inflation.
It's a mature market. I mean, almost everyone in the U.S. who wants a card already has one. The market is saturated. But then you look at Latin America.
Latin America was the absolute star.
Yeah.
GDV up 14.2%, purchase volume up 16.5%.
That's massive. And that isn't just people spending more money. That's millions of new people entering the formal financial system. That's people in Brazil and Mexico moving from a cash life to a digital life.
And Europe was strong too, wasn't it? 10% growth.
Surprisingly strong, given all the headwinds over there.
Mm.
But again, it shows you that the shift away from cash is a stronger force than the macroeconomy itself.
Yeah.
Even if the economy is flat, if people switch from cash to cards, Mastercard grows.
So if the U.S. is slowing down, Mastercard is hedged. They've got Brazil and Europe firing on all cylinders.
That is the whole diversification play in a nutshell. It keeps the overall ship moving at a really nice clip.
I want to touch on a specific partnership the CEO mentioned. He made a point to call out winning with programs like the Apple Card.
Yeah, that was a very specific shout out.
Why does that one matter so much? It's just one card, right?
It's not about the card. It's about the ecosystem. The Apple Card lives inside the iPhone. It's digital first. By anchoring themselves to Apple, Mastercard secures its place in the mobile wallet war. It keeps big tech from trying to build a system that bypasses them entirely.
So it's as much a defensive move as it is an offensive one.
Precisely. It's a strategic moat. It keeps them relevant.
Okay, we've talked about the money coming in. We should probably talk about the money going out. Expenses were up.
Operating expenses increased by 10%.
And it wasn't just, hiring people. There were some ugly details. I saw litigation provisions. They took a $174 million charge in Q4. That feels like a lot of money to just vanish.
This is the cost of doing business when you're in a duopoly.
Can you break that down? Merchant class, litigation, opt-outs, it sounds like a legal nightmare.
It's the eternal battle. Merchants, retailers, they hate paying the swipe fees.
Yeah.
There have been these massive class action lawsuits going on for decades arguing the fees are too high.
So the stores are suing the networks.
Constantly. So every once in a while, Mastercard has to set aside a pot of money, in this case $174 million, to settle with merchants who are pursuing their own claims.
So it's basically just a tax they have to pay to keep the system running.
Exactly. It's a drag on earnings, but for a company this profitable, it's just seen as manageable. It's priced in.
Speaking of taxes, the real taxes were up too. I found this interesting. The tax rate jumped from 14.1% to 16.7%. And the report specifically calls out something called Singapore Pillar 2.
This is a perfect example of how geopolitics directly hits a stock.
Yeah, I mean, Pillar 2 sounds like a sci-fi movie sequel, but what does it actually mean for their profits?
It's the global minimum tax framework. For years, big companies would set up headquarters in low-tax places like Singapore or Ireland. Governments finally got together and agreed on a 15% minimum tax floor to stop that race to the bottom.
And Singapore implemented that rule.
Yep. It kicked in for 2025. Mastercard has a huge hub in Singapore. Suddenly, all those international profits that used to be taxed at a very low rate are now hit with that 15% minimum, that little jump in their tax rate. That's millions of dollars straight out of shareholders' pockets.
It's just fascinating that a policy decision made in a room in Singapore directly shaves cents off the earnings per share in New York.
It's the reality of being a multinational. You can't hide anymore.
There was also a quick mention of a $104 million loss on equity investments.
Yeah, that's their venture capital arm. They invest in small fintech startups.
Trying to find the next big thing before it gets bid.
Exactly. Sometimes those bets pay off, sometimes they don't. In Q4, the value of those investments went down. It happens.
Okay, so despite the lawsuits, higher taxes, and some bad startup bets, they still cleared $4.3 billion in adjusted profit. Let's look ahead to 2026. What are they telling us?
The outlook is pretty confident. They're forecasting net revenue growth at the high end of low double digits.
I love that corporate speak. So what's that, like 13, maybe 14%?
Roughly, yeah. But here's the key part. They expect operating expenses to grow at the high end of high single digits. So call it 9%.
So revenue grows at 13%, but expenses only grow at 9%.
And that is the magic formula. It's called positive operating leverage. As long as that top line is growing faster than the expense line, their profit margins just get wider and wider.
And they are clearly confident. I saw the buyback numbers.
They were aggressive. $3.6 billion in stock buybacks just in Q4. That's 6.4 million shares they just took off the market.
That seems like a lot for just 3 months.
It's huge. And it's the ultimate vote of confidence. Management is basically saying, we looked at everywhere we could put this cash, and we decided the best investment in the world is our own stock.
And they still have another, what, $16.7 billion authorized for more buybacks.
So they have plenty of dry powder left. It provides a nice floor for the stock price.
So pulling this all together, we have a company where the U.S. is a little sluggish, but the rest of the world is picking up the slack. People are worried about prices, but they're still booking flights. And the company itself is navigating higher taxes and legal fees, but their efficiency is just off the charts.
And the pivot. You can't forget the pivot. The fact that services are growing at 26% is, to me, the single most important number in this entire report.
It changes the whole narrative. It's not just a toll road anymore. It's an intelligent security grid that runs on top of the road.
Precisely. If that services revenue keeps compounding at that rate, in 5 or 10 years, the actual swiping fees could become the secondary business. We're watching the metamorphosis in real time.
That is a wild thought. We might have to stop calling them a payments processor.
We might. They're becoming a data and security infrastructure company.
Here's my final thought then, for you to chew on. Next time you pull out your card, or more likely, tap your phone to pay for something. Think about what just happened. You didn't just move money. You triggered a fraud check, a data analytics point, a loyalty calculation, probably a currency conversion, all in less than a second.
And Mastercard got paid for every single one of those things.
Exactly. The plastic is just the interface. The real business is the invisible code that's running the global economy.
And based on these numbers, that code is worth a whole lot of money.
Thank you for helping us decode all of this today. It is always a pleasure to look under the hood.
Anytime. The numbers never lie.
And thank you to everyone listening to this deep dive. If you enjoyed it, keep your eyes peeled for the next one. We'll see you then. Keep learning.